macro currency signals.
The market is quiet, too quiet. Not the kind of quiet where nothing is happening, the kind where everything is happening, but only if you know where to look. Because right now, beneath the surface of the global financial system, silver is tightening. Not in headlines, not in trending feeds, not in loud retail chatter, but in the plumbing, in the pipes, in the places where metal actually moves. And when silver tightens in the plumbing, something breaks. For decades, silver has existed in two worlds: the visible world, price charts, futures contracts, paper leverage, daily volatility, and the invisible world, refinery allocation, industrial demand, vault flows, and commercial bar inventories moving between continents. Most people only watch the first world. The second world is where stress builds. And right now, the stress is measurable. Here's what makes this different. Before we go any further, if this is clicking for you, make sure you're subscribed and notifications are on. In moments like this, timing isn't optional. Being early is the advantage. Drop a comment with where you're watching from and what time it is there. This isn't a local story, it's global. And the reach of this conversation says more than the headlines ever will. Now, pay attention to what just happened. In a perfectly efficient global market, price differences between regions do not last. If one region trades consistently higher than another, metal flows. Traders arbitrage, the spread compresses. That is how free markets self-correct. But what happens when the spread doesn't close? What happens when one side of the world continues to trade at a premium week after week, and the metal doesn't fully flow to balance it? That is not noise, that is friction. And friction inside a physical commodity is not theoretical. It means someone, somewhere, is paying up for real metal instead of paper exposure. That distinction matters more than almost anyone realizes, because silver's global benchmark price is still largely dictated by derivative markets. Futures exchanges set the tone. Paper contracts establish the daily rhythm. And as long as enough physical metal can be delivered at that price, the system holds. But what if that price no longer reflects the urgency of physical demand? For years, anytime silver slipped into backwardation, where near-term delivery traded higher than future contracts, it resolved quickly. A few days of stress, then metal appeared. The gap closed. Balance restored. Temporary, contained, controlled. This time hasn't felt temporary. This time the physical market pushed back. And when physical markets push back against derivative pricing, volatility follows. You saw it. Massive upward moves, violent pullbacks, sudden one-day corrections that felt like traps. Price spikes that seemed unstoppable. Then sharp reversals that shook out leverage. That kind of behavior doesn't happen in sleepy markets. It happens when control is contested. Silver is not a deep market compared to oil or gold. It is thinner, less capitalized, more sensitive to concentrated flows. That makes it vulnerable to sharp repricing when real demand overwhelms positioning. And right now, positioning is tight. Let's talk inventory, but properly, not total vault holdings. That number is misleading. What matters is deliverable metal, registered metal, metal tagged and ready for delivery. Metal that can leave. Eligible metal sits there too, but it must be converted before delivery. It belongs to strong hands, long-term holders, strategic positions. It is not automatically available. Retagging bars inside vaults, changing ownership without moving a single ounce, does not increase supply. It only shifts titles. So when people claim hundreds of millions of ounces sit in vaults, ask the better question. How much of that is actually mobile? How much is actually for sale? Because in stressed markets, the number that matters is not total inventory. It is float. And float has been fluctuating in ways that don't align with calm narratives. Another myth that needs to be dismantled, the idea that leverage is still at extreme, reckless historical levels. It isn't. The old 100-to-1 coverage narrative has largely faded. Leverage exists? Yes. It always will in derivatives. But the idea that the system is operating with catastrophic naked exposure is outdated. Risk managers are not suicidal. Institutions reduce exposure when volatility increases. They trim leverage when stress rises. They do not double down blindly. So if leverage isn't the immediate ticking bomb, what is? Demand. Industrial demand does not care about daily price swings. It cares about ounces, flow rate, allocation for the next 12 to 24 months, production continuity. Silver is embedded in technologies that cannot simply pause because of futures volatility. Solar expansion alone has been absorbing increasing amounts of metal, electric infrastructure, electronics, defense components, advanced manufacturing. When silver becomes a percentage-heavy input cost in high-growth sectors, procurement shifts from price-sensitive to supply-sensitive. And supply-sensitive demand changes market behavior. Because when buyers fear availability more than price, premiums emerge. That's what we're seeing. Persistent premiums in regions closely tied to fabrication and industrial allocation are not speculative anomalies. They are signals. Signals that the physical pipeline is not perfectly elastic. Signals that metal is being pulled, not traded. Now layer something else on top. Global trust in macroeconomic data has been eroding. Official numbers say one thing, lived experience says another. Inflation models smooth volatility, but real-world costs don't smooth so easily. When confidence in currency stability weakens, even slightly, hard assets quietly benefit. Not explosively at first, quietly. Accumulation does not announce itself, it leaves footprints later, and in silver, footprints are forming. Add in geopolitical fragmentation, trade realignments, strategic resource positioning, countries seeking greater control over supply chains, industrial metals becoming strategic considerations rather than mere commodities. Silver sits at the intersection of monetary metal and industrial input. That dual identity makes it unpredictable, because it reacts to both inflation psychology and production cycles. Right now, both forces are aligned. Price behavior tells the story. After explosive upside movement, silver entered consolidation, stabilization between major levels, support holding, volatility compressing. Compression is not weakness, compression is stored energy. And when a thin market compresses under structural demand, breakouts become asymmetrical. If price convincingly clears resistance levels, momentum capital returns. Algorithms re-engage. Technical traders pile in. Industrial buyers accelerate hedging. Momentum in silver feeds on itself. But here's the part almost nobody wants to talk about. Markets peak not when news is bad, but when news feels unstoppable. The final phase of a commodity bull cycle is the most dramatic and the most deceptive. 90% of the move often happens in the last 10% of time. And if that is where we are, 2 weeks matters. Because when markets transition from consolidation to expansion, it doesn't unfold politely. It gaps. It surges. It reprices in days what took months to build. Is that guaranteed? No, but the setup is there. Persistent regional premiums, tightening deliverable supply, industrial demand insensitive to volatility, a thinner market structure, reduced but not eliminated leverage, rising geopolitical tension, eroding macro trust. Individually, these are data points. Together, they form pressure, and pressure in commodities does not dissipate quietly, it releases. The question is not whether silver can move violently, it already has. The question is whether the next move overwhelms the current framework. Because if physical demand forces sustained price discovery beyond derivative comfort zones, the repricing will not feel incremental. It will feel sudden. And the system, exchanges, refiners, commercial hedgers, will adapt in real time. Position limits may tighten, margin requirements may shift, liquidity could thin temporarily, volatility would spike, weak hands exit, strong hands accumulate, and headlines will pretend it was obvious in hindsight. But right now, it doesn't look obvious. It looks calm. That is what makes it dangerous. Silver doesn't need chaos to rise. It needs imbalance. And imbalance is forming. If support levels hold and resistance breaks, momentum capital returns. If regional premiums persist, arbitrage pressure increases. If industrial procurement accelerates, float shrinks further. And if confidence in paper claims softens even slightly, preference shifts toward allocated ownership. None of this requires conspiracy. It requires math, supply versus demand, deliverable versus theoretical, flow versus inventory. For years, the derivative tail wagged the physical dog, but tails only wag while the dog is fed. Starve the dog long enough and it stops responding to the tail. We are not in a confirmed shortage, not yet. But stress is measurable, and stress that persists tends to resolve in price. 2 weeks may sound dramatic, but in compressed markets, 2 weeks is an eternity. Watch the spreads, watch deliverable categories, watch regional premiums, watch whether consolidation breaks upward with volume, because if it does, the repricing won't ask permission. And the people who only watched the surface will say it came out of nowhere. It didn't. It built quietly, and it's still building. Right now, silver is sitting at a crossroads between two forces that rarely collide at the same time. On one side, you have the derivative framework, structured, regulated, margin-based, algorithmically driven. It thrives on liquidity. It thrives on predictability. It thrives on participants believing that contracts represent metal. On the other side, you have physical reality, industrial demand, fabrication schedules, refinery throughput, vault withdrawals, bar allocations. That side does not care about open interest. It cares about ounces in hand. Most of the time, these two worlds coexist peacefully. Price discovery happens on exchanges. Physical follows that price. If demand rises, futures adjust. If supply loosens, futures soften. A dance. But what we are entering now is not a normal dance, because the derivative market depends on confidence. Confidence that when a contract stands for delivery, the system can deliver. Confidence that large positions can roll forward without stressing the pipeline. Confidence that spreads will normalize. When those assumptions weaken, even slightly, behavior changes. It doesn't change loudly. It changes quietly at first. More contracts stand for delivery instead of rolling forward. More participants request allocation instead of cash settlement. More industrial buyers secure longer-term supply rather than relying on spot availability. These are subtle shifts. But in a market as thin as silver, subtle shifts compound fast. Let's talk about flow. Silver production does not suddenly double because price rises. Mining is slow, capital intensive, constrained by geology, permitting, energy costs, and labor. And much of global silver production is actually a byproduct of other mining operations. That means output is tied to copper, zinc, and lead cycles, not purely to silver price incentives. So when demand spikes, supply does not instantly respond. That creates lag. Lag creates imbalance. Imbalance creates volatility. Now add something else. Industrial demand for silver is not discretionary in the way jewelry or speculative demand can be. In certain sectors, silver is not optional. It is functionally embedded in processes that cannot easily substitute away without redesigning entire production systems. If you are manufacturing energy infrastructure, advanced electronics, high-efficiency components, you do not pause production because price is inconvenient. You secure supply. And when multiple industries attempt to secure supply simultaneously, premiums rise. That is where things get interesting. Because persistent premiums in physical markets represent something deeper than just enthusiasm. They represent urgency. And urgency in a physical commodity often precedes a repricing event. Now imagine this scenario. Consolidation holds. Price stabilizes above a critical support level. Market participants relax slightly. Volatility compresses. Short positions build again, assuming the rally was overextended. Then, in a short window, physical demand accelerates. Deliverable categories tighten, regional premiums widen instead of compressing, and a key resistance level breaks with volume. In that moment, the derivative market must reprice risk immediately. Shorts scramble to cover. Momentum capital flows back in. Algorithms trigger buy signals. Volatility expands. That is how thin markets go vertical. Not gradually, suddenly. But here's where it becomes systemic. When price accelerates too quickly, exchanges respond. Margin requirements rise, position limits tighten, liquidity providers widen spreads. Risk desks reassess exposure. All of this happens in real time. Now ask yourself, what happens if, during that repricing phase, physical requests increase instead of decrease? What happens if rising price does not cool demand, but intensifies procurement? That is when derivative pricing begins to lose its dominance, because derivatives are ultimately claims. Physical metal is settlement. If too many claims convert into settlement demands at once, the system strains. Not collapses immediately, strains. And strain changes behavior. Participants who once trusted paper exposure may begin seeking allocated holdings. Investors who once rolled contracts may stand for delivery. Industrial buyers who once purchased month-to-month may lock in multi-quarter allocations. Each of these behaviors reduces float further. And float is everything. Remember, total inventory numbers can look healthy while actual available supply is tight. The difference between eligible and registered metal matters most during stress. Metal sitting in vaults does not equal metal for sale. Ownership matters. Intent matters. If strong hands hold eligible metal and do not convert it to deliverable form, the registered category becomes the pressure valve. And if that valve tightens while price rises, confidence shifts. Now zoom out. The broader macro environment is not neutral. Debt levels globally remain elevated. Currency purchasing power continues to erode gradually. Governments prefer inflation to deflation. Monetary systems function on managed perception. In that context, hard assets do not need crisis to appreciate. They need erosion, slow erosion of trust, Silver carries a dual psychology. To some, it is an industrial input. To others, it is monetary insurance. When those two identities activate simultaneously, volatility increases dramatically. And we are seeing both activate now. Industrial procurement is rising. Investment interest is returning. The gold-silver ratio has compressed from extremes, but historically, it can compress much further in late-stage cycles. If silver begins outperforming at a faster rate relative to gold, that signals capital rotation within the metals complex. And that is a late-cycle characteristic. Late-cycle phases are emotional, they are dramatic, they produce headlines like the one you're watching right now, but what makes this particular moment dangerous is not excitement. It is structural fragility. A market does not need 100-to-1 leverage to experience disruption. It only needs a mismatch between paper claims and physical willingness. And that mismatch does not show up cleanly on charts. It shows up in behavior. Premium persistence, allocation delays, unusual delivery activity, inventory reshuffling between vault networks, metal flowing across oceans in response to regional demand imbalances. When those patterns cluster together, probability shifts, not certainty, probability, 2 weeks. Why does that time frame matter? Because consolidation phases do not last forever. Markets coil, they build energy. Technical structures compress between support and resistance. The longer compression holds, the more violent the breakout. If silver decisively clears a major resistance level in the coming weeks, the psychological ceiling breaks with it. Round numbers matter more than people admit. Triple-digit pricing changes narrative. It changes how mainstream capital perceives the asset. It changes media coverage tone. It changes risk models. And once narrative shifts, inflows follow. But let's be honest about something. Parabolic moves do not last indefinitely. The final phase of a commodity bull market is fast, euphoric, and unstable. 90% of the move can happen in a small fraction of time. That means upside opportunity and downside risk both increase. If the gold-silver ratio compresses toward historically aggressive levels, that becomes a warning sign that the move is extended. Markets do not move in straight lines forever, but they can move much farther than rational minds expect before reversing. So what are we really watching for in the next 2 weeks? We are watching whether physical tension forces derivative repricing. We are watching whether consolidation resolves upward with conviction. We are watching whether premiums persist or widen. We are watching whether inventory categories tighten meaningfully. We are watching whether volatility expansion aligns with demand expansion. If those signals synchronize, the repricing event becomes self-reinforcing. If they do not, silver may continue consolidating longer, frustrating both bulls and bears. But here's the critical insight. The system does not look unstable on the surface. That is precisely when instability forms. Systemic events rarely announce themselves with sirens. They build under normal conditions. They build while analysts debate. They build while headlines focus elsewhere. Then, when they surface, the narrative becomes retrospective. People say the signs were obvious. Right now, the signs are subtle. Persistent premium, thin float, industrial urgency, macro erosion, technical compression. That combination does not guarantee explosion, but it creates a symmetry, and asymmetry is where opportunity and shock live. If silver enters its final acceleration phase, it will not politely notify the market. It will gap higher. It will retrace violently. It will shake confidence. It will test margin. It will create disbelief, and it will expose who understood the difference between paper and physical and who did not. 2 weeks is not prophecy. It is a window where compression could resolve, a window where derivative confidence could be tested, a window where physical demand could overwhelm comfort. If nothing happens, the story continues. If something does happen, it will move fast. Silver has a history of extreme volatility during late-stage cycles. That history is not ancient. It is cyclical. And cycles, when forgotten, tend to repeat with more intensity. The question is not whether silver can shock markets. It already has, multiple times in history. The question is whether the current structural tension is enough to trigger the next shock. We are closer to that answer than most realize, because pressure does not disappear. It resolves, upward or downward, but never sideways forever. And here's the part almost nobody wants to admit. By the time it becomes obvious, it will already be too late. Silver does not send invitations before it moves. It doesn't trend on social media first. It doesn't politely warn traders that the window is closing. It shifts quietly, then violently. And when it does, the same people who dismissed the premiums, ignored the tightening float, laughed at the consolidation, and trusted the surface numbers will suddenly call it unpredictable. But it won't be unpredictable. It will be the natural outcome of pressure that was allowed to build for too long. Right now, we are standing at the edge of a compression phase that cannot last forever. Physical demand is real. Industrial necessity is real. Inventory dynamics are real. And when those forces collide with a thin derivative structure, repricing doesn't trickle, it surges. Maybe it happens in 2 weeks. Maybe it takes slightly longer. But when it begins, it won't feel gradual. It will feel like something snapped. The spread will move. The volume will expand. The headlines will change tone overnight, and the narrative will shift from overextended rally to unexpected breakout. That's how late cycle commodity moves behave. So watch closely, not the noise, not the daily chatter, not the emotional swings. Watch the structure, watch the flow, watch the pressure, because something is building. And when silver decides to move, it doesn't ask for permission, it just moves.